Here's the MCA debt stack problem and how to consolidate it. If you're a business owner and this is not your first merchant cash advance, this is for you. One MCA is manageable, 2 or 3 stacked on top of each other is a different problem entirely. And it is not a high interest rate problem. However, that is one of the big problems. It's also a cash flow problem. So let's get fair up it. Why MCA loan stacking happens? Your first advance, second advance, third advance. According to Second Wind Consultants, once multiple advances sit on top of each other, plus existing secured debt, the issue stops being about cost and becomes structural. Daily or weekly withdrawals compounding faster than the business can absorb them. So the daily withdrawal death spiral. Advance 1 pulls its own daily or weekly payment straight out of the business account before payroll, before rent, before anything else. Advance 2, a second advance means a second withdrawal competing directly with the cash the business needs to actually operate. And then advance 3, a third stacked advance doesn't add pressure, it multiplies it. The business account is drained before operations can even function. So what the real math looks like. 780 a day, daily payment on a 150K MCA structured as daily debt. That's 16,375 a month, monthly equivalent coming straight out of the business before anything else. That's 150K as the advance, the size of the advance that generates this payment burden, not the headline rate. Now that 16,375 a month is the number that breaks businesses, not the headline interest rate. So what refinancing actually looks like. Before refinancing, the situation looks like 16,000 a month pulled daily from your account on 150K worth of stacked merchant cash advances, leaving almost nothing for operations. After refinancing, we could be looking at as low as 4,900 a month in one fixed payment. According to Noble Funding's published numbers, that's roughly 11,465 back in the business every month, freeing up cash flow and restored in one move. What legitimate consolidation is actually made of and how you can dig yourself out of this hole. According to Value Capital Funding, real MCA consolidation is not a settlement gimmick. It replaces the advances with one lower cost payment sourced from an actual lender. So there's a few routes you could go here. Firstly, we got the term loan, which is a structured loan with a fixed rate repayment, replacing the multiple advance obligations, typically 3 to 5 years. You've got an SBA-backed loan if you qualify. Business lines of credit are great for this. Flexible revolving credit, replacing rigid daily advance withdrawals, or a specialist consolidation lender. Go talk to them as well. The other great thing is a HELOC. If you've got a home or an LLC owned investment property that you could pull equity out of to pay this down, they're timed to the prime rate. So much better terms than your MCA stack. So what qualifying actually takes? Credit score, 650 minimum. You want at least a 680. If you haven't already buggered your credit score from maxing out your credit cards to keep up, this is required as a baseline for long-term MCA refinance products. Net income, positive net income in at least one of the last 2 years, a clean record, no past bankruptcies, no open state or federal tax liens, and then time in business, minimum 18 months operating, rates starting around 9%, cash flow based underwriting, no specific collateral required. However, you can also collateralize with the UCC lien. Now, why this is different from a consumer credit card problem. Consumer credit card debt, personal loan rate comparison, individual financial health, tied to utilization and suppressing FICO and other loan rates and terms. Now, it's worth mentioning, if you have maxed out personal cards to actually get yourself out, you're going to want to do a personal debt consolidation on your cards before you go for the term loan or the business line of credit to dig yourself out of the MCA. So you've jacked up your FICO and you're ready for better terms. Stacked MCA debt. A business owner trying to keep the doors open, structural daily withdrawal pressure, different stakes, different mechanics, different fix, and almost no consolidation content written for this version of the problem. Now, where this fits in the debt consolidation tool, stacked MCA debt is exactly the shape of what debt consolidation is built to solve. Rolling high interest MCA obligations into one fixed lower rate payment, typically over 3 to 5 years if it's a term loan, or a revolving line if it's a business line of credit. Now, you got multiple MCAs right now. Daily withdrawals stacked, competing with operations. You go into consolidation, one fixed payment, one lender, one structure, and you're funded fast in as little as 1 to 5 days, no waiting months for a bank to move. Here's the recap. It's a cash flow problem first. Stacked MCA debt breaks businesses through daily withdrawal pressure, not headline interest rates. Refinancing frees up real money. One fixed payment can return 5 figures a month to the business, depending on the size of the advances involved. An underserved conversation. This is a genuinely different problem than credit card debt consolidation, and almost no one is writing about the MCA version. So let's map your deal. If MCA payments are eating your business alive, it's time to see what refinancing actually looks like with your specific situation. One move, one fixed payment, 5 figures back in your business every month, if that's where you're at. Now apply at gapfunded.com/apply, link in the description below. I'm Mick Wadley. Let's dig out of this hole. And if you love this video, hit the subscribe and smack that bell. I'll see you on the next one.